Hey guys, today I've got an awesome guest for the show. You won't believe it. He's a very well-renowned researcher worldwide for his works. It's Professor Yermack. He's produced many different papers and studies over the different decades with a few different topics that we want to delve into during this interview, from cryptocurrency to Bitcoin to even more topics of efficiency, corporate government, corporate entities, how they are flexible, how they're efficient, different things of governance, blockchains, and so on. And so we dive right into it. Professor Yermack, thank you very much. Would you be so kind to tell the audience a bit about yourself and your biography? How did you get into that whole field of research?
Okay, thank you for the invitation to come on the podcast. And I've been on the faculty at NYU for 30 years, and I joined here when I finished my PhD from Harvard in 1994. But going way back, I knew I wanted to be a professor about the age of 16. And this is unusual that, most of my colleagues who are academics, they kind of stumble into the profession, or maybe a professor recruits them because they're a good student. But I was actually born in Princeton and grew up with many children of faculty from the university there, but was very aware of the academic culture and thought that the work was interesting, but also that it was very significant, and that you would, if you did it well, you would advance the frontiers of knowledge, you would teach and inspire your students. There's a lot of really intrinsic pleasure in being a professor and a teacher, and this was obvious to me even when I was a high school student. So I went to graduate school. I was fortunate to be admitted. I wrote my dissertation. Back at the beginning, I was really much more in the mainstream doing corporate finance. My dissertation research was on executive stock options. And I was fortunate to get a job in the finance group at NYU, which then as now was by consensus one of the top 5 departments in the world. And once I got to NYU, I met a lot of interesting colleagues. Many of them became collaborators and co-authors. And my research branched out. And I think most significantly, about 10 years ago, I became one of the first academics seriously to research cryptocurrency and to think about the possibilities not only of the crypto assets, but more broadly, the blockchain technology and what it might mean in financial markets, but in many other sectors too. And I think pivoting in the direction of crypto was a great career move. At the time, I was about 40 years old, and many professors, their research starts to run dry after their 30s. And for me, this has been sort of a whole second career, and one that has generally gotten me better invitations, put me in front of more prestigious audiences and so forth. I was a pretty successful professor before, but it really opened up a whole new frontier to start doing crypto and get in on the ground floor of what's turned out to be a very interesting area.
Wow. I mean, I looked up your work and I know about it, but I've got to admit, I personally stumbled upon your older works first, and that's how I got my attention on you, because I was researching about efficiency of teams, and I got into the whole the board members, the size of the board, if it is more efficient, if it's smaller or bigger. And that was the first paper and work of yours that I stumbled upon, and the whole crypto stuff was only afterwards when I trickled down your different papers.
I was successful researching corporate governance. I'm proud of my record, and some of those papers have become real mainstays in the academic literature. And I still try to keep my hand in. I'm working on a couple governance projects even now, although I would say the majority of my attention really is focused on crypto. But the governance problems are very interesting, and they're universal. They occur in societies all over the world.
Would you be with me if I would like to ask you a few things about your older research first, and we go
Of course.
Great. So one of the questions was about the lucky CEOs and the lucky directors. It was a question of, you analyzed a bit the timing of stock options that were given to the different board members, to the different CEOs, if it's just a coincidence of the timing, or if it is like a hidden method to pay them out even more. that in itself is a very interesting question, and it is tied with another point of the managerial entrenchment and capital structure of how do they make money, how are they incentivized to do good stuff, and on the other side, as far as I understood it in your papers, how they are not punished in a way if they are doing bad works. Could you give me a bit of an overview regarding, imagine someone has never been in a board meeting or doesn't really know about the C-suite. What is it like to be a CEO, to make the money, to crash the company, to make it soar high? What can I expect in these kind of fields?
Yeah, I'm not a CEO myself. I'm an academic, and I sit on the outside and, pass judgment on these people who have to actually get in the trenches and make the decisions. But CEOs are subject to incentives. They have compensation structures and ownership, and they respond to incentives and rewards just like you would predict in microeconomics. And CEOs also have their own personal preferences and biases. And in graduate school, I studied very closely a topic called agency costs. And there's a whole branch of economics called principal agent theory that looks at the very general problem that if you hire somebody else to do a job on your behalf, the agent won't do the job exactly the way you want. And the relevant case in business is that the CEO is hired by the shareholders, and the assignment is to raise the stock price as high as possible, run the company in a way that generates a good rate of return. And there are things that get in the way of that. Some CEOs have poor incentives. Others are pursuing objectives that are not aligned with the shareholders. They have different goals and interests. And a lot of them really don't have the talent and the skills. To be a good CEO means that you have to be, one in a million in the business world. Someone who has both knowledge and wisdom and judgment. And good CEOs are hard to come by, just like good football players, good politicians. It's scarce to find people who are really good at this. So boards who hire and fire the CEO tend to replace them rather quickly and try to tinker with their incentives. But for the most part, most companies are going to be disappointed. The number of firms that actually match well with a manager who does well and is happy in the role and so forth, it's a clear minority, but some of them do very well. Now, you mentioned some research papers I published over time, and in fact, the first one about the timing of stock option awards, that's probably the one that made my reputation when I was young.
No.
So managers are paid in shares and stock options. And when I was a doctoral student back in the early 90s, there was a disclosure reform where the SEC in the United States began requiring companies to disclose the dates on which the managers got their stock options.
Okay.
And right away, I thought, let's look at these dates, because there was a long line of research about the timing of stock trading, falls into the category of insider trading. And my suspicion was that you would find something very similar with the awards of compensation, that there would be better than average timing. The phrase you used, lucky CEOs and lucky directors, those are actually titles of papers that other people wrote down the road. But what I found was a very clear pattern that when managers got option awards, the CEOs in particular, the stock began to rise almost immediately, in a pattern that was just too good to be true, that it couldn't have happened by chance or by accident, given the very large size of the sample and so forth. And so I speculated that managers were holding back good news, that if you knew you'd be getting options, say, next week, and you had good news to announce, wait until you have the options, and then a day later, announce the news that will raise the stock price and make your options more valuable. Now, in hindsight, I got this only about half right, because a different researcher, Eric Lee at the University of Iowa, he found exactly the same pattern, and he conjectured that this could actually be people backdating the awards, the choosing the dates after the fact and looking for local minimums in the share price. And he built a very interesting case for that. And I give Eric enormous credit for really establishing the result. And ultimately this turned into an investigative series by the Wall Street Journal, where Eric and I both provide some support in the background. And a lot of companies had to restate their financials. I think one CEO actually went to jail briefly. And,
Wow.
there's widespread corruption. The paper on option timing was really the first of several that I wrote that showed a degree of corruption in the process for compensating CEOs, and called into question with good academic rigor that the process was not as neat and clean as it seemed. And many other researchers then went into the area and wrote other papers and books and so forth. And I'm glad to have kind of started this research stampede in this direction, because it always seemed to me, even as a PhD student, that the system was fundamentally rigged against the stockholders and in favor of the managers.
I'm a bit curious in that task. What were the consequences like on a personal level? I just can't imagine it. You're a researcher, you put out these papers that cause huge uproar on Wall Street for many, many, many companies. SEC gets involved, Wall Street Journal gets involved. What was it like? Or did it not touch you at all? What was it like?
I would get a minor amount of hate mail from CEOs. And for a while, I was saying to my colleagues, if at least one CEO doesn't go to jail when I publish a new paper, then I'm not going about it the right way. But what you saw over time was some changes in the disclosure rules, that the SEC definitely took notice. And two categories in particular, the use of corporate jets and perks like that was much better documented after I wrote a research study on that. And also compensation for things like pensions and deferred compensation that appreciates in the background, but for some CEOs is enormously important. There's much better disclosure on that as well. And again, that happened right after I wrote a major paper on that and documented the importance of it and some of the blind spots in the disclosure and so forth. So, ultimately, you're looking for impact on regulation that will feed into better behavior. And I think today the process of setting compensation is much better. People are more careful, better directors serve on boards. People are much better informed about what can go wrong. I think you're not seeing some of the really egregious outcomes that occurred with some frequency when I first got into the field 30 years ago. And that's a good thing. I think, to a large extent, some of the most outrageous problems have really been cleaned up.
Okay. You mentioned something on which you wrote a whole paper, corporate jets. Can you tell my viewers a bit about what that paper was about? What's flights of fancy? Like, what is it with the CEOs, corporate jets, and your paper?
One of my favorite studies in, what that came out of was just reading every year hundreds of disclosures of CEOs' compensation. These are all in documents that get filed with the SEC. And just because of the nature of my work, I read these a lot. And over time, I was seeing this footnote more and more often about the CEO being allowed to use the company's airplane for personal travel. So, most companies have aircraft for business travel. And, that may or may not be a good idea. But we're talking about something distinctly different here, which is where there's a plane and the CEO can take the plane, go on vacation, for the weekend or whatever. And some companies permit this, do not. And what I found was that the frequency of this was rising over time. And my data was really for the decade of the 90s. And the company that began to permit this performed much, much worse as soon as the CEO was given the aircraft. In other words, it's taking the company plane on vacation. You want to be short the stock. This is a company that's not going to do well. And this led to all kinds of speculations. It's not the cost of the airplane itself, which is very small compared to these companies, but is the CEO lazy? Are they overly boastful and overconfident? There's lots and lots of conjectures, which made the seminar presentations very fun and led to people already kind of looked at this perk, but they looked at it much more closely after I published this study. And one thing that I was able to do, and you can't do this anymore, but back in the day, you could go on the US Golf Association website and get the dates of the golf played and also the location where golf was being played by every registered golfer with a handicap. So this is now behind a password, and you have to be a member of the USGA. But when I wrote the paper about 20 years ago, you could actually download the golf histories of all the CEOs who played golf, which was many of them. And this lined up very closely with the airplane use. That you could explain much of the use of the airplane by the golfing activity and what I called long distance golfers, guys who were members of country clubs that were not near their headquarters. So you might have headquarters in Indiana and be a member of a golf club in Colorado or Palm Beach, and that's where the plane was going. So, it made the presentation a lot of fun. The data was very entertaining to collect and so forth. And I remember when I finished the paper, I emailed it to 3 or 4 friends, knowing what would happen, which is that they forwarded it. And by the end of the day, hundreds of people and, the media was calling and everything. It's fun when something goes viral like that. And it's happened a handful of times in my career, but definitely the JET paper was very, very popular. It reached an audience instantly.
I can understand why and how. Absolutely. I would like one question before we go into the crypto space would be, you also research efficiency with the team sizes, or rather not team size, but the board size.
Right.
I would like to ask to tell the audience a bit about what you found, the results behind it, but also if the results only apply to a board, or is it more a general thing about teams in general? Because that's how I got into. I wanted to know for a complete different thing than a boardroom, the size of good team building, that's efficiency or not. So please.
So this is actually by far my most cited, highest impact paper. And it looks at the value of a company as a function of the size of the board of directors, simply how many people are on the board. And it's very inverse, that the smaller the board, the better the company does. And there are some very big, valuable companies like Apple that have small boards. So, it's not, generally boards are bigger when the company's bigger, but it doesn't have to be that way. Now, the idea came from Michael Jensen, who was one of my professors in business school. In fact, he's the intellectual father of principal agent theory. So much of my research connects right back to work done by Jensen. And this is true of many finance professors of my generation. But Jensen had written a paper in 1993 with this conjecture that smaller boards would probably do better. And Jensen, in turn, got the idea from Marty Lipton, who's a famous takeover lawyer at Wachtell Lipton here in New York. And Lipton had written about this in the law reviews. So it's a very easy hypothesis to test. I just had collected a lot of data about boards for my PhD dissertation, and you could very easily look at the board size and the value of the company. And it's one of these research studies that the first time you run the numbers, it was just very sharp, strongly downward sloping. It took a while to get this through peer review. There was a lot of skepticism. Different editors and referees, tried to reject the paper or to, kill it with other explanations, but it went through 5 rounds of peer review, which is unusually high. But once it got into print, it's been very highly cited. This is really one of the important papers in corporate governance, one of the most cited and downloaded, and it's probably more than any other paper, the one that made my academic reputation just in terms of the statistics and the numbers. Now, my belief is that this is a very general result, that anyone who's ever served on a committee with 15 people and on a committee with 4 people, you can tell the difference. And, basically on big committees, there's a lot of free riding. People, they don't prepare, they let other people take responsibility, they don't come to meetings, but there's nowhere to hide on a small board. And I think that it would be a better world if you had boards not only of publicly traded companies, but of charities, of country clubs, of condominiums. Anytime that you need a group to be in charge of oversight, keep it small. Just get a handful of people who are willing to take responsibility and do the work, and don't burden them. Boards, they tend to get very big in business, often due to mergers and acquisitions, where you say, well, we need a director from the company we just bought. Some seats are filled just for diversity. We need an expert in this, an expert in that. We need people of different genders, different ethnic groups. We need old people, young people. When you start giving out board seats for reasons other than the expertise of the directors, you are just filling the room with people and creating all kinds of coordination and scheduling problems. Keep it small. I've found that I work in the nonprofit world in higher education, and things always go better when there's fewer people in the room.
Yeah, really interesting. Really, really interesting take. I stumbled upon an experiment when I found that paper too, from another researcher whose name I don't remember right now, sadly. There was, the bigger the team or the bigger the group is that has to make a decision, the more risky the decisions get, because each of the individuals can say, well, there were so many others who thought that idea was good too. So they're more likely to do risky things because they can put the responsibility on the group instead of having it as an individual, while at the same time communications in the group gets worse and worse and worse, so the informations are not shared as well. So the end result is
I have to tell you,
yep.
This is 180 degrees the opposite of what we find in business, that there's a general problem that companies don't take enough risk. And when you have a small group, they're willing to commit to a risky strategy. But when there's a big committee, you kind of push everyone toward the center, you search for consensus, and you tend to throw out, the more extreme ideas and, go for the safe one that, looks respectable. So I think you see this very much in politics.
Yeah, really interesting, because also in I've been doing charity work for 15 years now almost, so I know that nonprofit sector too, and you're right. Very interesting that in business it's different, don't you? What are your personal opinion? I know there's not that much research on that topic from your side, but you read a lot of papers. I'm sure you remember names of the CEOs, of the stories behind it. Don't you think many of the issues are too, how should I say, eccentric or too aggressive, or risky CEOs? Or do you think more companies had issues because they were not risky enough? Wow.
I think it's very much the latter. I would be looking at big companies in my research, S&P 500, large cap firms. They're very bureaucratic. Yeah. And what you find is that when an investment needs to be made, it goes through committees, and there's long presentations, lawyers get involved, and things get slowed down. And basically, the more interesting ideas tend to get ruled out and watered down and so forth. So it's a big problem that as companies get big, they become risk averse. And it's really the younger companies with nothing to lose that take the big risks and end up, not all those risks play out, but the real high impact ideas tend to come from smaller firms that are not bound by the bureaucracy and the caution that you see in bigger companies. It's a major problem in business. And when firms get big, they get a lot less interesting and less entrepreneurial.
Really interesting, really interesting. I did not connect. I always knew about the speed, like the oil tanker needs way too long to change the course. But I didn't connect it in my mind immediately with risk aversion. I just thought, okay, they're so bureaucratic that it takes too long to get to the result fast. I didn't think of it being as they're not willing to risk a fast approach. That's an interesting thing to reflect upon. Thank you very much. Really
one of the great critics of corporate boards was Ross Perot. You may remember he ran for president of the United States, but he was very successful in business And he ended up selling his computer firm to General Motors, and he got on the board of General Motors. And he was completely frustrated. He said if there was a snake here, they would form a committee on snakes and study. He says you just need someone to kill the snake, not study it and write a report on, and he says the speed at which corporate decisions are taken makes it hopeless for them, to get it right. By the time they figure out the right answer, it's already, the ship has sailed and so forth. And
wow, very interesting. Wow. Thank you very much for these insights. Really, really grateful for that. And now I gotta ask, how do you go from all of that kind of research to crypto? Please tell me, where was that switch?
So my interest in crypto really came from reading about it in the news media and connecting it back to a course I'd taken in high school on protest literature. So there was a novel I read all the way back in the late 1970s by Thomas Pynchon called The Crying of Lot 49. And it's about a group of libertarians who start a secret underground post office, and they're trying to subvert the government's control of their lives, and they have secret signs, and the whole thing kind of grows up into this network. And I read about Bitcoin, and this was a subversive currency started by libertarians. I looked at the whole mission and I said, this is just like that novel from high school, except they're not running a post office, they're running a bank. But it's the same people, the same mission. And I was amused by it, but then I was even more surprised that I kept reading about it, that it hadn't blown itself up, but it actually seemed to be in some kind of a stable equilibrium. And with that, I said, I need to understand how this works. And I took the time to understand the blockchain and the mining and all the moving parts. This would have been 2012, 2013, back when this was still a pretty new thing. And, it was just beginning to appear in the news media. I'd read about it maybe once a month in the Wall Street Journal. Once I figured this out, and this took some time, but once it all clicked, I thought, this is the cleverest thing I've ever seen. And not only is this extremely clever, but you're going to see the whole finance industry migrate to this. And we need to offer a course on this in the university. This is going to be too important. So, a lot of people thought I was completely crazy, but really my belief in the creativity and the robustness of the technology is what drove me to commit to it. I looked at it very carefully. I thought, this is just way too interesting to walk away from. And I approached a colleague at NYU Law School who taught banking law. This is Jeff Miller. And Jeff knew a little bit about Bitcoin already, and he agreed to teach a course with me that would be focused partly on the finance and partly on the regulation. So we launched this. It met for the first time in 2014. So this is our 10th year. We had about 33 students the first time out, but within a couple of years, we had hundreds. And, the whole field took on a life of its own pretty quickly. But, it was really from the connection to the libertarian culture and, the impulse of people trying to subvert government institutions, and in this case, the central bank. I was amused by them, but then pretty impressed at what they had come up with. That, this looks like it might not just be a way to oppose the central bank, but it could also, replace the stock exchange and, many other things. Anyone trying to transfer assets, which, people do all over the world, millions of people every day, probably can do it better on a blockchain than on a double entry bookkeeping traditional ledger.
Well, explain to some of my viewers why, in as layman's terms as possible, not a technical explanation of the blockchain, but why is it a good idea, or why is it a good solution, and for what is it a good solution?
So it provides much more security and transparency than the banking system that we have now. So if I wanted to pay you, let's say I owed you money for something and we're in different countries, I could instruct my bank to send money to your account. It would take about 3 days. There would be big fees, and the money would kind of disappear. It would leave my account, but there'd be a long blackout before it showed up in your account. And it turns out, there's a very convoluted explanation for this, but it's basically due to there are so many risks and weaknesses in the way that we transmit money. It's a very 19th century process that really has never been updated. Yeah. So on a blockchain, you can do this instantly. Both sides can see the whole thing, and you can look at the history of all the transactions made in order to verify not only that the transaction occurred, but that the person who paid you had the funds to pay you. That everything we worry about with credit checks and people being able to fulfill their debts and so forth, all of this is very transparent on a blockchain. And the security is just vastly higher. The amount spent in the background on cybersecurity and identity theft every year around the world, just hundreds of billions of dollars. And potentially all of this can be saved in the long run if we move to a more secure system. So, there's a long explanation for how the technology accomplishes this, but I've looked at this and decided it's the biggest breakthrough in finance since double entry bookkeeping itself, which arrived during the Renaissance. And 700 years ago, this was a huge upgrade in the way that we kept track of who owed how much to whom and where did the money come from and where was it being held. After double entry bookkeeping, we had much more confidence in people's financial accounts and were willing to invest. And I think you should look at the blockchain as a successor, that very much in the line of other innovations that have occurred really for thousands of years. It's a better way to keep track of people's assets and liabilities.
I'm dabbling in that kind of field. I've had other interview partners for another channel that's in German because I'm from Europe. I'm in Austria. I've got another German. The English channel is the new thing for me. I'm a bit curious about the transparency idea behind it, and it is very transparent. But doesn't it also mean that we've got no privacy left, and also that it's a dangerous thing in regards of, let's say, tyranny or whatever negative thing you want to imagine? It's like, okay, now you can check out who spent money on what 10 years ago, 5 years ago, 15 years ago, what that asset has who ever owned this one asset before, and so on. Isn't it? Because I just had that question recently with an NFT collector. And he was like, oh, I'm very happy. You can look into my wallet and you see all of the NFTs that I've got. And we like it that you can see that. And to me, it was like, oh, I don't want everybody to see in my home which books I've got or what paintings I've got on my walls and stuff like that. So, I mean, I'm not sure. I think the Europeans are technically always a bit more paranoid regarding data security because we've had more recent negative experiences, like if you look at the last century. So what is your take on that aspect?
This is a very important issue, and we spend several classes talking about privacy in our course. So if you go back to the people who created Bitcoin, we don't know exactly who they were. The author used a false name, Satoshi Nakamoto, and I think Satoshi is probably a group, not just one individual. But they thought they were creating something very private. In fact, Bitcoin was supposed to be a reaction to the lack of privacy in the current financial system. Now, Satoshi's system gave people addresses that are called public keys, and they're like a 64-character mix of letters and numbers. And the assumption Satoshi made was that you could hide behind the private key and people wouldn't be able to figure out who you were. That's turned out to be very, very naive. In fact, it's quite easy to match up people's private keys and their true identities if you just know a little bit about their economic footprint. You can know if someone ate at a certain restaurant. You can go back on the blockchain and download all the wallets that were used to pay at that restaurant, and just get a few more pieces of information. And there are now big companies that do these forensics and, are quite good at, inverting the whole system to figure out whose wallet has what assets. So I tell the students, don't ever buy drugs on the blockchain. That you're leaving the information there forever, because not only can blockchains be decoded, but they are forever. They can't be rewritten. So once it's there for good. So I think you have to think about the trade-offs between privacy and some of the other benefits of a financial system that's very secure and fast and transparent. And without taking a stand on what those trade-offs are, we just try to get the students to talk about this in class. And we've had some very thoughtful commentary and questions over the years. I think you look around the world, and there are some societies, such as in Scandinavia, where there's no privacy. You can look up your neighbor's tax return, their medical history, and it doesn't really bother them. That's just kind of the social structure that they've always had. And we do a lot of economic research in those countries because you can get this data that is protected and guarded in the United States and much of Europe. You also see generational differences. I'm always shocked by my kids' behavior online, and it's not just me. Like, all the parents feel this way. Like, these young people don't care about privacy, and they don't. They look at it very differently than people in my generation. And I think ultimately, privacy is a choice that is not free. And if we want it, we have to be prepared indirectly to pay for it by giving up other conveniences, hiding behind platforms that restrict what we can do and so forth. And I think different people will have different preferences. And what would be best is a system that accommodated everybody's wishes. But I don't think you can just lay down rules like the EU has done, saying that everyone has the right to be forgotten, all data is private, it can be deleted, blah, blah, blah. These things are never absolute. They involve trade-offs. And just getting students to think very thoughtfully about the price of privacy and what they're willing to pay for it, is a very interesting way to spend an hour in a classroom. So, I think there's a lot more to be heard on this issue, that we're moving very quickly toward a world of central bank digital currency where the government really will have your whole transaction history. And they'll be able to see what you'll do, but they'll also be able to stop all the tax evasion and money laundering. And we would all benefit from that if, all the tax cheats had to actually pay what they owe. So again, trade-offs, and some very interesting trade-offs. If you want pure privacy, though, you have to go back to cash. That's the only truly private financial system, is if I hand you a $20 bill and then you give it to someone else and no one knows you got it from me. Cash has always played that role, but it's very cumbersome to use cash. And so, cash is really less and less circulated every year.
I thought the same, but I had the fortunate luck recently to be allowed to meet with one of the ECB guys from the central bank and discuss a few of these topics with them. Yeah. And because I had recently an interview with someone who was like, oh, the CBDC is absolute conspiracy, tyranny, and so on. And then I met someone from the central bank, and I was like, hey, cool timing. I just had that guy on 2 weeks ago. I would like to talk to you about these things. We were at the nice gathering, eating together and so on. And it was like, his response was, he was laughing and saying, if we wanted to control, we could do it with cash just as well. All of the notes have the codes. In China, if you look at the Chinese system, each knife has a registry code. Who owns a knife is known in a database from the government. And you can't give the knife away without someone knowing, hey, if this knife is ever found, you were the one who bought it. Why did you give it away and not sign up that it was stolen or da-da-da-da? Same could any moment apply to cash. In the registers, there could be a little, how do you say, a sensor taking up these registry codes. It's not registry code. I don't know the English correct term for it. Like, each note has its own little code. So they could do it just that way too. And I was like, what, you could? And he was like, yeah,
you're probably right.
We could do it. And he said, so we're not going to do it because of that control aspect. And I'm still like, I don't know. It could be, it could not be. Really interesting topic, in my opinion. Really interesting. What do you think personally about it?
One of our politicians in the U.S. was recently arrested and charged with a whole bunch of crimes. And he had a bunch of gold stuffed in his sock drawer. You may have seen this in the press. You know, cash, he had a lot of cash too, but he also had bars of gold. And
Yeah.
clearly privacy was important to him, but it's pretty cumbersome. Gold is heavy, and you know, it sets off metal detectors at the airport. It's hard to transport without people figuring out what you're up to.
Really? Oh man, oh man, oh man. So let's go back to the more direct questions with the, are you a fan of Bitcoin or are you a fan of the blockchain technology in itself? I think many people don't make a proper distinction here. So I would like to know which of it is.
Yeah, there's a big difference. I've never really thought that Bitcoin was going to be with us permanently, that
Okay.
it's very 2009 in terms of the technology. And I think Bitcoin is tremendously important for historical reasons, but it's not anybody's idea of a good payment system. So, you know, what it was designed to do was for people to make micropayments using their cell phones and so forth. Nobody actually uses it for that. People instead use it as perhaps a substitute for gold, as a, you know, a hedge against risky things going on in the real economy. But I don't think the data support that it performs either role terribly well. And the price of Bitcoin, in fact, it's been kind of on fire the last couple of days. Nobody really knows why. And I can't begin to explain why one Bitcoin is worth 30,000 or 35,000. I've never owned any of the cryptos myself. They just are so risky and by and large don't have any intrinsic value that you can justify paying for. It's the technology, as you suggest, the blockchain, and not only the blockchain, but the way the blockchain is updated. In the case of Bitcoin, there's a competition every 10 minutes of people around the world trying to write the next block and get a reward if they're successful. And the other cryptos, and we now have tens of thousands, but they all have their own mechanism for what's called consensus. Consensus is where you reach agreement that a certain transaction has occurred and goes into the ledger. And a lot of these algorithms are extremely clever. They tend to use game theory and aspects of microeconomics. And it's a substitute for having an accountant or some trusted third party vouching that the money's there. You know, that's the classical system, is just to get somebody to audit and authorize and attest that things look okay. But there have been so many failures of that system that using the incentives and, you know, the open nature of blockchains where anybody can participate in these games just makes it very attractive compared to the classical alternatives of using auditors and regulators, all of whom have been shown under different situations to be corrupt and ineffective in their jobs.
Really interesting take. Wow. Thank you very much for that. Really quite interesting. Wow. That you don't own any crypto yourself
Oh,
is a
no.
bit.
You'd have to
Wow.
be crazy.
How?
No, like, why would I?
At least just for fun. I mean, you writing papers on that stuff. Take $100 and invest into what do I know,
I have
1,000.
4 kids, and I found a few years ago that of my 4 kids, 2 out of 4 own crypto, and I was horrified because I did not tell them. I'd given them, you know, the opposite advice. Now, one of my children at age 13 actually mined it at home, and I thought this was cool, like as a science project, and I wasn't even involved, and I was very proud. But my oldest, my son, got his stimulus check, the $1,200 from the government back in 2020. And like a lot of people, he bought Bitcoin. You know, he didn't really need the money. He was back at home with us. So he bought Bitcoin, and he bought it exactly at the right time because the price just took off in 2020. By August, he had tripled his money. He said, "Dad, this is easy. You know, I'm going to do this as a job." And I said, "No, you know, it can go down just as quickly." And, you know, we had a lot of interesting conversations about investing. But for a while, he got drawn in, you know, as we've seen in many of these crypto cycles, that when it goes up, it sometimes goes up very fast because there's a lot of momentum investors who will get involved. And my boy was one of these for, you know, a year or two. I hope he's not anymore.
Yeah, it's wow, really interesting. Well, about the regulations and such, at least in Europe, we're getting ready to implement a new regulation set. And
Yes.
as you know, Europe has a problem. We regulate everything to the point where we can't compete with America anymore. And even if the rules are, even if you would say, okay, the rules are good and it works well, we're going to be so far behind that it doesn't matter anymore because nobody else plays with the same rules. It's the same with the data protection, GDPR rules. It's the same with the NICAR now, with the NFT and cryptos and so on. And it will be the same with the AI Protection Act, where it's
So
also.
I would agree that in principle, the European Union overregulates things. I think that's easy to, to see, and it has all kinds of costs on entrepreneurship and, financial markets and so forth. But in the US, at least with crypto, we've had a very different problem, which is the regulators have failed to understand it and to regulate it on its own terms. They've tried to pretend that it's an investment security like a stock, and to say that these rules we've had from the 1930s and 40s should apply to crypto. Those rules were passed even before computers existed. And crypto has many interesting issues, but they're not the same issues that you meet in the stock market. So nobody really knows in the US what the law is. There's widespread agreement that the US should have a crypto regulatory code, but nobody agrees on who the right regulator is. Is it securities regulator, the commodities, the banking? And Congress needs to step in and clarify this, but the story with our Congress, that they can't even convene because they can't elect leadership. It's a big, big mess. So I think if we ever get Congress back in session, crypto is not going to be the urgent priority, but sooner or later, I hope Congress does something. The European code looks interesting. I would say Switzerland has done the best job, but you can look at other jurisdictions. Singapore, the United Arab Emirates have been very thoughtful. Hong Kong, US is way behind. And I think, frankly, the next 10 to 20 years, all over the world, you're going to see countries struggling with this, looking for best practices. You'll eventually see the best rules bubble to the top and be widely imitated. They're not coming out of the US, though, because we haven't even made any rules yet. It's just people fighting over who's in charge and so forth.
Wow, because you mentioned your US Congress, I remember listening to the Mark Zuckerberg hearing, one of those, for like a few hours because I'm very interested in these things. And it was crazy to see how little technical literacy was there, where I thought, wow, these people ask questions that show they got no clue about technology. Absolutely.
I have to agree.
And they're supposed to get proper regulations in place. That's going to be messy. That's going to be very messy. Wow.
No, it's been pretty disgraceful how the US regulators have met crypto up to now. And I had hoped Gary Gensler would be more thoughtful because he taught crypto at MIT, but he's been even more reactionary than the guy who was in the role before him, Jay Clayton at the SEC. And I can't repeat enough that this is not a stock or a bond. It's not the kind of asset that we've had before. It's an asset that's protected by cryptography, it's a new thing. And it solves many problems, but it creates other problems. And, that's really what the regulator needs to be focusing on.
Very interesting. Very, very, very interesting take. Thank you very much for that. I know your time is very valuable. If I can just put in one more question for a moment. About now remember your personal opinion, just as an easy question. I would like to know. At first, everyone was, oh, crypto is the wild, wild west. Leave it untouched, leave it untouched. Anybody who goes into it should be carrying their own risks. Then a few issues came up. Remember, first Mt. Gox, and then and many others who don't need to be named happened again and again and again. And each time, those people who lost money wanted regulators to step into it. What is your personal opinion? Because I myself just thought, well, just let all the people who invested go bankrupt. That's your problem. You wanted to invest into something that had no regulations. Keep a field that has no regulations. And if the people lose all of their money, that's tough luck.
Yeah, I've always said that to say crypto is like the Wild West is unfair to the Wild West. The crypto is far more unruly and harder to understand. And I think anyone who invests in this shouldn't be naive that there's no protection. There's a lot of frauds. The current trial with FTX and all the collateral damage of people who were invested in the platform. A lot of these folks pretty much got what they deserve for not taking the least bit of care. And this goes back to why I've said I would never own crypto, because I know who's controlling it and promoting it, and how little control and accountability there is. And there are many markets full of fraud, like the market for used cars. And people don't say the government should regulate used cars. If you go to buy a used car, that it's a used car, and it's probably going to break down, and it probably has a shady history. And here's this new asset that's issued over a computer network, and we don't know who the promoters are, and the rules can change. Should you invest your life savings in this? No. But if you do, I don't think you can expect the government to ride to your rescue. This is it's a very tall order for the government to regulate this intelligently and correctly. And up to now, that's just not happening.
Yeah, it's like we're not allowing people to burn their hands when they reach for a hot stove. It's like,
Yes,
man,
exactly.
don't touch it. You're gonna burn your hand. And then as long as it's profits, it's fine, it's fine, it's fine. The moment you gotta burn your hand, they say, oh no, we don't want the consequences. It's crazy. Well, Professor Yermack, and thank you very much. It was a great pleasure talking to you. Awesome to hear about the way it developed in your life. Kind of crazy, honestly. And I just can't believe it. I mean, I believe it, of course, but most surprising take is that you don't own any crypto yourself. It's
absolutely not.
Really interesting. Wow.
I've enjoyed my career as a professor. It's a wonderful way to make a living. The work is interesting. You're really not accountable to anyone other than the standard set by the profession. You can decide how to spend your time, what you want to study. And it's been really a great run for me. The 30 years I've spent in the finance group at NYU have been a lot of fun. And, I'm grateful for having had the opportunity.
Well, thank you very much for taking the time, being a guest on the show. I wish you and your family only the very, very best. And thank you very much for being part of the show. Thank you.
Thank you. I appreciate the invitation.